Well, good afternoon, or at least, excuse me, noon. This is Ralph Gale, and this is Coffee with Ralph. Listen, every Thursday, I bring something to the table that I think is important for us to talk about, or at least for me to talk about, you to listen. I just want you to remember that coffeewithralph.com is a free 15-minute call with me at your convenience to discuss whatever you wish to discuss. But I'm going to start with a little story because it just happened just before the first of the year. I was on my way into the office and met up with a janitor type job. Well, not janitor. He was replacing some carpet tile in the hallway. And as I came out of my office and went to the restroom and did whatever I had to do, he stopped me and he's talking about carpet and glue and things of that nature. And I went, "You got me off base here." Interesting conversation. So we continued, but I looked at him and I said, I'm sorry, I'm not sure I quite understand why you're asking me about glue and carpet tiles and things of that nature. He goes, well, aren't you the janitor? I just had to chuckle a little bit. I did have my flannel shirt on. And I said, no, I'm a financial advisor. It's my office right there. And he goes, oh, well, you don't look like any of the financial managers that I know. So I just thought you were the janitor. I went, I guess that speaks to what makes me different, but I'm just an everyday guy that I'd rather wear a flannel shirt than a suit. So there we go. Anyways, today I thought I'd start our conversation on life insurance. It's the first of the year. It's a new beginning for lots of people. And I keep seeing these silly commercials. They're not silly. They're to the point, from this company or that company about guaranteed life insurance and how everybody should have it. I'm sorry if I cough or whatever. I have to full disclosure here. I am just getting over the flu, so I'm doing this at home. But it is Thursday, so let's get on with it. But talking about life insurance, and one woman says, "Well, look, honey, I'm going to leave you all this when I go. It's just a garage full of stuff." And she goes, "Oh well, don't worry about it. I've also got a life insurance for $30,000." And of course, the question goes, "Well, what about your health, mom? How'd you do it?" Well, with this with this in policy, there's um there's no health questions. And that's wonderful. If we've got health issues, we've got a way to get people insured. But it's kind of like, if I don't ask you any health questions as an insurance company, then what we're going to do is we're going to take it no matter what, and we're going to wait a couple years before we pay out a benefit. And we're going to make sure you know that, um, just in case you don't make it a couple years. Maybe you're trying to get this life insurance now that you have cancer and you've been told you have less than a month. So, there's a purpose for it. But that kind of is my point of my conversation. There's a purpose for every type of life insurance out there. So let's start with some basics. There's term insurance. What is term insurance? And that's what we're going to kind of focus in on a bit today. Well, what is term insurance? Most people think that's life insurance, and they have this idea that it's going to last them for their whole life. Well, no, it isn't. It's going to last you for the term you take it for. If you take a 5-year term, that's insurance for you for that 5 years. If you take 10, it's 10, 15, 20, 30. It's not permanent. It doesn't stay there until you pass away. It's kind of like going to the casino and pulling that one-armed bandit, I think. Um, are you gambling that you're going to die in that period, in that term? And the company is gambling that you don't. That might be why less than 1% of all term policies are collected upon. So what is term good for? Well, we'll talk about that in a minute. But let's move on. And really, there's only two types. There's term and there's permanent. There's variations of the permanent from the variable universal life, which is life insurance that invests in mutual funds. There's index universal life, which is life that uses credits interest against an index like the S&P or the Dow Jones, but isn't invested in it. It's just reflective of what they're gaining, but no loss. Variable life, you can lose on your asset base, on the cash value, as it goes up and down. Mutual funds go up and down. Indexed universal life or universal life hasn't got that catch. The worst you can make is zero. The most you can make is whatever they say is going to be the cap. And then there's whole life. And there's a couple of terms on that. There's a thing called graded whole life, for example, that is, well, that's that one. No health questions, but for the first 2 years, you have no benefit. Or sometimes there's a 30% benefit followed by a 60% benefit, 100% in the third year. Whatever the case may be, if you die in that time period, you get your money back plus some interest. And that's, like say, good if you can't get life insurance any other way, or you feel uncomfortable answering the health questions that go with a permanent policy or even a term policy, if that's the case. So where's term good for? If it goes away after a certain period of time, what's it good for? Well, it's good for young couples. It's good for anyone that's got a large piece of debt that they want to insure their spouse or their family against. A $500,000 home that they don't want to leave the wife dangling on the hook for if they pass away unexpectedly. Then there's the credit life term, which is good for however long you have that loan, and it's only good for what's on the loan. So as the loan goes down in value, so does the death benefit. But let's take a 10-year term. Why would I pick a 10-year term? Well, excuse me, I'm just uncomfortable. So again, I'm just getting over the flu. So bear with me. So what's it good for? Well, you got the young couple that's got a large debt, or young family that needs to make sure they have enough money if dad passes away or mom passes away unexpectedly. A large piece of debt might be out there. Something of that nature. And yeah, they've got 10 and 20 and 30-year term. So why not take a 30-year term and put it on a mortgage? Well, let's take a look at the financial side of that. You put it out for 30 years and you get your mortgage paid off, and you've paid this insurance policy for 30 years, and now it's worth nothing. That's right, nothing. And there's no cash value in it. None of the premiums you paid are going to come back to you unless you put a return of premium rider on it. And then it's simply the premium you've paid, which means you've lost growth that you might have experienced had it been invested in a stock market or something of that nature, or even in a CD. There's growth no matter what you do, except in the return of premium rider on term insurance. Then there's the one big benefit, and I will say there is a benefit to term. Most people will never look at it that way, but there is a benefit. I take a young family, got a couple of children, got colleges looking out, you got dads, whatever dad is, accountant, CPA, factory work, it doesn't matter. He's going to make $1 million in his lifetime at least. But if he dies prematurely, we can affect the family's livelihood and lifestyle simply by not having that income. So let's protect the income. Get a large amount for a little bit of money. And most companies now will let you convert that. Most of it is convertible. So somewhere in the future, you can take a piece of it, all of it, none of it, but you can at least convert it into a permanent life insurance policy, which will go for the rest of your life. Now, permanent policies, what good are they? Well, first off, they're for your entire life. Secondly, all of them have cash value, which means there's the availability of loans against that cash value, which you can pay back at interest. Usually that's less money than the bank would charge you for interest. Some of them have interesting internal mechanisms where the interest might be 1 or 2% or less. So where's the value there? Well, there's a couple of them now, and a lot of the permanent policies, most of the permanent policies are now putting on long-term care or chronically ill terms, chronic illness riders on it, so that as we get older and we start needing care, for example, whether that's in a home or in a facility, we have the availability of the death benefit to help pay for that care. So now I've invested a little bit of money and I've got a lot of coverage for that thing none of us want to talk about. It's also, however, a way to help fund the retirement. Many programs allow you to put in more than the premium, and that goes straight into the cash value, which sits there and gains at interest, right? And so if I can range for a net 1 or 2% loan and no taxes, that's right, no taxes are on loans from life insurance. So if I could do that, wouldn't that be a good way to offset inflation, market corrections, all these other things? Another place to get your money in case the stock market's being crazy like it is right now, or we do hit that recession. The last thing you want to do is take money out of the accounts that are going down. So why not take money out of the account that's stable? Huh. Interesting process there. So term life, let's finish up with this. Big debt, young family, specific need. A lot of companies put term life on their executives, for example, or partners may put it on the other partner just in case. You know, many companies are based on partnerships that I'm good at marketing and you're good at manufacturing or getting the product. You know, so we both have our points. Well, if I don't have somebody out there selling what I've got, then I've got nothing. So I need to insure both sides of that. It's an interesting use of a little bit of money to get a lot of coverage for a specific amount of time and protect my insurability so that no matter what, hey, I have a term policy, 20-year term policy. It's about ready to come due. And all of a sudden I get to the doctor and the doctor says, hey, Ralph, guess what? We found cancer. What's the prognosis here, doctor? Well, probably pretty good. We're going to be able to take care of it, but you never know. It's cancer, right? Okay, at that moment in time, run over to your local life insurance agent and say, I want $1 million policy, Ralph. Are you currently seeking treatment for any medical advice or medical situation? That's one of the questions. Matter of fact, they're considered a knockout question. If you say, well, yes, Ralph, I just got the cancer diagnosis, I don't even put the application in. I don't even continue. You've disqualified yourself right there. However, you have that $1 million term policy and you call me and say, hey, Ralph, I want to convert $500,000 of it right now to permanent insurance because I got a cancer diagnosis. Oh, okay. We can do that. There are no health questions asked at that point in time. And you get the rating that you had when you were first insured. So as a young person, you get a super preferred rating, best rating in the world, lowest premiums possible. Now I'm 50. Now I'm 50. I've got cancer or I've got some life-threatening thing, or I just want to convert it. I still get super preferred, even though now I might be 50 pounds overweight, don't go to the gym every day and drink a lot of beer. They don't care because they insured you from then till now. you get the benefit of the doubt and you get the rating you got before. So listen, like I said, coffeewithralph.com is free 15-minute call. Question me on this. Please bring it to the table and say, I'm not sure I understood what that guaranteed insurability clause is all about. Why is that so important? Hey, I want you to have a great day. We're running out of time today. I hope you enjoyed today's meeting, and I will see you next week.